Welcome to the Get Real Podcast, your high-octane boost of in the trenches, tell it like it is reality therapy for personal, business, and real estate investing success. With your hosts, powerpreneurs, Angela Thomas and Ron Phillips. It's time to get real.
Hi, welcome to the Get Real podcast. This is Angela Thomas, and I'm here with Ron Phillips.
Here we are.
Ron. Hey.
Let's do this.
Hey, so I'm out in Utah. I know your weather's a little nicer out there where you are, Ron. But man, here in Utah, I just know every time of year it's the ugliest. It's cloudy. It's freezing, and on top of all that, it's my favorite season. Tax season. So woohoo! Thought we should
love it.
Yeah.
I just figured maybe not for anybody else's benefit other than for yours, that I would just look up the weather real quick out here.
Oh, great. Okay, well,
I can see outside that it's sunny. It is a little breezy today, but it's 68, so kind of chilly.
Well, we have tons of snow that is not melting at all. It's stuck on, so that'll tell you. It's stuck on all the trees, it's beautiful. Except I hate it. But
I'd love to tell you I miss it, but I don't. Let's talk about taxes.
Okay.
You're going to get depressed.
I know. Let's not talk about the weather. So, although taxes are a little depressing also. So
Not today. Not today.
Today we're going to laugh about them.
We're going to, yes.
There's this quote. I really love this quote. Will Rogers, I'm not sure who that is, but he said the difference between...
It's just because you're a whippersnapper.
You want to tell me who Will Rogers is?
No, you need to look it up so you'll remember.
Well, I'll look it up later. Anyway.
Stud though. Everybody, he's got a bunch more really good quotes too.
Yeah. So he said the difference between death and taxes is that death doesn't get worse every time Congress meets.
And isn't that the truth?
That's just great.
Isn't that the truth? What gets better when Congress meets? Anything? Does anything ever get any better?
Not for me. I don't know.
I don't think so. I think they should just not meet.
Good plan.
Yeah, but they definitely shouldn't get together on taxes. That never ends well.
No, it really doesn't. So Ron, I think you had an example you were going to share. I know you've told me before about.
I think people need to understand a little better how taxes affect them and their investments. So that's what we're going to talk about up front. And then we'll talk about maybe how to not have this happen to you.
Right.
Now, I think everybody out there has heard about the, would you rather have a penny a day for 30 days compounded daily, or would you rather have $1 million? And
yeah, if you haven't seen that on Facebook, you've been under a rock. So
yeah, it's been around forever. For anybody who hasn't heard of this, I can tell you how this works, right? It's a penny the first day, second day it's 2, third day it's 4, 8, 16, 64, $1.28, right? It's just not, on day 15, you got $163. And you're thinking to yourself, this is not working for me. But on day 20, you've got 5,242. Ooh, maybe you should have taken the million, right? And then, but 5,200 turns into 10,500, turns into 20,000, then 40,000, then 80,000, then 167,000, and then 335,000. Day 27, you got 671. Things are looking up because now we're going to be day 28, 1.3, day 29, 2.6, day 30, 5.368 million.
Wow.
It's a big number.
It's crazy every time you hear it. Whew.
It's a big number. And I just kind of ran through it really quick so you kind of see, but you can do a simple Google search on this and you can come up with it. Yeah. So in 30 days, a penny doubled every day becomes $5,368,000. It's insane. Wow. Now, here's the point I want to make. Compounded interest is fantastic. I think anybody that hasn't been living under a rock knows that. At least you know that when you pay compounded interest to your credit card company, that it's really bad. So if you're on the receiving end of it, stands to reason it would be really good, right?
Right.
So that's what we're all after. We want this compounded interest. What I want to do, though, is I want to show you what is it that just taxes does to this. What if we tax every day the returns before it's doubled, right? So you earn a penny, you get taxed on the penny, and then you get your gains, okay? So not to belabor this, but if you're at a 30% tax bracket, okay, which is not that crazy, because I think the top tax bracket's somewhere around 40 now. So at 15, here's your gain and your net. So here's your net. 15 days, your net is $16.84. Now, I mean, it wasn't, look, if you compare that, it wasn't crazy different than the other one, but it is different. Okay. Sorry, I just clicked a button and
Oh no.
Sorry. Just give me a second. Day 15, you were at $163 before. So now we're at $16.84.
That's pretty drastic. I mean, percentage wise, man.
Very dramatic difference, right? And it's because of the taxes that are coming out of your gains every single time. Fast forward all the way to the end of the month. Day 30, having been taxed only 30% on all of your gains.
Okay.
You ready for this number, Angela?
No, I'm terrified, man.
We went from 6 million?
Mm-hmm.
Call it 5 to $48,196.86.
Ouch, man.
So what's the actual effect of us, quote, paying our fair share? The effect is staggering on your money. Okay. And, I saw this, anybody out there who's a Parks and Rec fan, Ron Swanson is he's like my hero. Love Ron Swanson, right?
So funny.
So there's an episode, and I just saw it again on Facebook. Somebody posted it the other day, where Ron is teaching a little girl that comes in to do a report. She has to talk to somebody in the government. So she finds Ron. And for those of you who've never seen the show, Ron is he works for the government, and he's completely anti-government, hates it. So he teaches her about taxes by dumping out her lunch and eating 40% of all of it. And at the very end, after he's eaten a whole bunch of her lunch, like 40 people, took a big bite out of her sandwich. At the end, he goes, ooh, I forgot about capital gains tax. And then he eats another bite of her sandwich. And you could keep going, right? There's death tax and taxes on taxes on taxes on taxes. It's insane. So to the extent that we can legally reduce our bill to the government, it's going to help our investments, obviously. And just in the last segment, we talked about 1031 exchanges. We're not going to talk a ton about them today, but I mean, goodness, you have to build money and pay less. You have to pay less taxes. It just annihilates your gains. And hopefully you can see that from this little example. I mean, 35%, Angela, 35%, just 5 percentage points more. So when all these jokers are out there talking about how they want to raise everybody's taxes, 5 percentage points more goes from $48,000 to $20,278. 5 percentage points.
Wow. It's crazy. Wow.
It's insidious is what it is.
It really is.
Insidious.
So you've experienced this, Ron. I mean, I've been working closely with you for a while, and I've watched you experience this as a business owner. And you're a business owner and you own rental properties.
Mm-hmm.
So, I think we should talk about a little bit like the differences between, your business, the taxes you have to pay on that compared to passive income rental property.
Yeah. And I think the first time that taxes really hit me in the gut was the year that the money that I actually took home not the money that the company made, but the money that Ron had in his hand, took home and used, was the exact same amount of my tax bill.
Yikes.
That year, I woke up, my accountant called me and he's like, okay, I got your taxes done. Here they are. And I said, so I net made $0 last year. Well, no. I mean, your company made X. I'm like, yeah, but my company has to have operating capital in it, right? I mean, my company has to have operating capital to move into January. I can't just take the money out. I didn't get that money.
Right.
But when you're an S corporation, this is one of the things I think people out there need to know. This is going a completely different direction than we thought it was going to.
Yeah, sorry. We'll get back.
I'm pissed, Angela.
I know.
I'm reliving
yes,
old
Ron Rand.
angry memories here.
Oh, I'm sorry.
But what people don't understand is that when a business owner has an S corporation, that means all the money from the business flows through to them on their tax return, whether they took the money and spent it or not, which in this case, I didn't. I needed it moving into the next year. I have to have money in the bank to be able to operate my business. But that is profit. That profit is passed through to me and it goes onto my personal tax return, which means I was paying top tier taxes on money I never even got. And that equaled the amount of money that I took home that year. And it was that year that I decided there has got to be a better way.
And if there's not, we are done.
I told him, I said, why does anyone go into business? This is ludicrous. I made no money. I net made $0 and worked all year last year. He goes, yeah, I mean, I said, well, how do you grow? I'm trying to get this accountant to go, how do you outgrow this? Because next year, if I make money, I'm going to have the same exact problem, right? And right. God forbid you didn't save the money out to pay those taxes, because then you have to dip into next year to pay last year's taxes. And guess what? The money you dipped into to pay last year's taxes, you are also taxed on.
Yeah, same way.
It's a never-ending battle. I'm telling you, if you're out there and you've never paid those kind of taxes before in your life, you cannot comprehend the level of stress that comes from earning $0. On paper, hundreds of thousands, right?
Yeah, paper doesn't.
In actuality, $0. And it was that year that I decided I needed to figure out what all these other rich people were doing and try to figure out how in the world do they pay less taxes? Because if you can't, you're in effect going to be out of business. Yeah. And that's the dirty little secret that nobody out there wants to talk about, right? Is that they talk about all the rich people out there, rich, of course, being defined as $250,000 or more. They talk about all the rich people out there. That means every single S corporation on the planet. They're all rich. They all have to pay this crazy tax, even on money that they actually don't ever personally get to use.
Right.
It's insidious. And how do you get ahead of that? Right?
Well, I mean, the same way as with your investment real estate, you have to figure out, loopholes or ways to offset that a little bit, and to save some money and get some money back in your pocket, right? I
guess, Angela, what I'm trying to say is that the penny thing that I just was trying to articulate to everybody, that happened in real life to me.
Yeah.
Not the same numbers, but that's exactly what happened. Yep. It killed my year in business. And I mean, it was such a gut punch. And it took me, I don't remember. You remember, I was like in a depressed state for days.
Yeah. And Ron is a happy, I don't know if you can tell, he's a happy, funny guy. And he was just not himself.
I was moping around the office like, why the hell am I even doing this? And I was trying to convince myself that I'm doing this because I'm helping other people, which I am. But damn, I want to get paid too at some point,
Yeah, man.
Anyway.
Yeah, that was
let's
rough.
Move on to something like this. This has not been happy so far. But
I know. So how we come out of this? I mean, I think we just need to talk about what you did about it, like and the difference. I mean, that's your business, but there are even more loopholes and tax breaks there's a bunch that you can use on your rental income as well. So yeah, I just want to talk about kind of what those are. We don't have to talk about all the ones in your business because we're focusing more on the real estate side, but you did figure out loopholes to prevent that from happening again, right?
Yeah. And everybody calls them loopholes. They're
not.
What they are is they're things that are put in there so that businesses don't go out of business.
Right.
And there's ways that I can redirect money that helps both all of my team, and it also benefits me. And they do that so that business owners won't just take all the money personally, but that they'll help their team. And I agree with that. I think we should do that as business owners. I don't have any problem with that. But it was trying to navigate all of that and try to figure out how do you do all of that stuff. Then you have to pay somebody to help you to help you navigate what.
And you had to keep looking for the right person to help you.
I had.
Not everyone knows. Yeah,
I had to go out and get another accountant.
And you may have to for your real estate as well.
You have to change your mentality. You have to change your mindset. When you hit a certain level of income, you have to change. And it's what we said. I don't remember how many episodes ago we were talking about. If you're looking at somebody and they're successful, go figure out what they've done. And that's what I did. Right. I had to get out of the office and off of my, pity potty. And I had to go out there and find people and go, what are you doing?
Exactly.
Keep your money. Because I just had all of mine taken, literally every cent. I had it all taken. So tell me what you're doing so that I can do what you're doing. And they introduced me to accountants who were versed in this stuff and could help me out. And because I was in the real estate space, they were like, look, there's other things you can do in the real estate space that can help you out on your business side, and things like that. So it's really critical at every step. Like if you're starting out, find people who are doing what you want to do and go ask those people what they're doing.
And who they're using, right?
All you have to do is just copy them
Yep.
in every aspect, but especially this one, the taxes, because they'll kill you.
Yeah. So specifically, so that was on your business. So let's talk about ways that those loopholes that are actually just, opportunities to make profit. Let's talk about what those are on real estate. Because it is kind of like operating your own little business, right?
It is. And if you're smart, you will have a company that's set up. And so you will be most definitely running a business.
Right.
And when you start a business, first off, we should probably say, Angela, that I am not an accountant. I don't think you are.
Yeah.
Were you in a previous life? You're pretty smart and you went to college and everything.
Not for finance.
That
exercise science, remember?
Science. That's right. Yeah, we did talk about that the other day.
It's a good thing too, because if I had gone for finances, I would hate them. So, yes, get a tax professional. And like Ron said, you might have to, go through a few before you find one that knows all these loopholes or opportunities. Because not everybody does. And you'll find accountants. I know my mom had to switch accountants a few times because she makes quite a bit more than I do with real estate. But she had to keep switching until she found somebody that kind of believed in real estate and knew about these tax breaks. So,
yeah. So, one that we talked about in our last episode was just that on your real estate, you get to write off. You get to depreciate your property. You get to write it off, and you get to write that off against your income you're getting from the property. So you can, in effect, you can reduce or eliminate the income coming from the property. It's fantastic. Hopefully you get so much cash flow from your property that doesn't eliminate it, but in some instances it can. And I don't think we have enough time to go over cost segregation studies, but there's definitely ways that you can do this with cost segregation, because in cost segregation, you're moving a lot of the expenses up to the front. You're front loading a lot of that 3.6%. You're front loading a ton of it up front, and that allows you to write off more, obviously more than you're making from the property.
Right.
And
awesome.
Little secret, if you're a real estate professional, ask your accountant about what that is. If you're a real estate professional, then there's no cap, and all that can be written off against your personal income from my business or from your job or whatever. Okay.
Cool.
So again, ask your accountant about that. But in addition to that, Angela, there's no FICA taxes on rental income.
Yeah. So huge difference between your business and your properties, right?
Yeah. So, and a lot of people don't even know what FICA taxes are, but you pay them. They come out, and if you can see them in your on your W-2 and on your pay stubs. Your employer is going to pay basically half of them. But if you're self-employed, in other words, if you work for yourself, you get the privilege of paying all of those. You get to pay 15.3% all by yourself. But on rental properties, on passive income, you don't have to pay that tax at all. So there's taxes right there that go away.
That even though you have, I think your property management is kind of like your employees, right? Running your business for you. But you don't have to pay any of those taxes on them. So you get to keep
because
all
those people run their own business. They're a 1099 business, and 1099 means they're not an employee of yours. So you don't have to pay any taxes on them either, because they're paying their own taxes over there in their business,
Yeah. That's a huge savings right there.
You can write off travel expenses to your property to go see it if you want to, repairs. And they've actually just done some pretty cool things with capital expenditures where you can depreciate a lot of them first year. Like, so some of these ones that you would do to your properties, like replacing roofs and things like that you would have to depreciate over time, you can depreciate those in the year that you do them.
Hey, they actually did improve something. Look at that.
They did. They got together and
it actually worked in our favor for once.
Did something right. Yeah.
Yes. Cool.
So if that's all they're going to do, then they should get together more often, but probably not.
Yeah. And then you can also deduct the fees you pay to your property management, right?
Yep. So because those are all expenses, so you can deduct all of your expenses. You don't get taxed for the appreciation on your property until you sell, right? So you're making money also for the part of the property that's being your principal reduction. Those gains are not taxed either. And then if you're smart, you can sell the property to do a 1031 exchange, which we talked about last time, which defers those taxes. In other words, you can sell, you can take a couple $100,000 out of your property, and you can sell it and put all $200,000 into more properties, increase your cash flow, and do this all over again without paying any taxes, because you're deferring them until later on. And then there are strategies to be able to make it so that you pretty much never do, and that when you pass away, your kids get a stepped up basis on your properties in your 1031s.
It's pretty cool stuff. Yeah, we have a lot of
start over again.
Yeah.
So there's some really cool things. I wish we had enough time to dive into, and maybe if you guys want to, let me just make some comments on our page. If you want us to, I'll come back and do, there's opportunity zones right now. Opportunity zones are really cool. Especially if you're planning on doing a 1031 exchange, because it's different. And really briefly, what it does is it allows you to exchange money without an intermediary. All you have to do is just buy into it gets complicated. Basically, you buy a property in a fund, and then an opportunity zone fund gives you, I can't remember the years, but if you hold it for 3 or 5 years or something like that, you get 15% off of your taxes that you would have paid on that exchange. If you hold the property for 10 years, you don't have to pay gains on any of the gain from that particular property that you bought in the opportunity zone.
Yeah, it's pretty cool.
Really powerful. Very cool. We could do maybe we can put that together with 1031s or something like that.
Cool. Yeah. Yeah, we'll have to get more detailed on all that. We also have some resources about that kind of stuff on our other website, RPC Invest. So feel free to check that out. There's some good videos on there.
And look, if you guys comment a ton that you want a lot more in depth on this stuff, maybe I can get my accountant to come on and we can really throw down in 2 or 3 segments about taxes from somebody who actually can tell you what it is, because
feel free to send any specific questions, and we'll have a guest on and have him answer them on here. So that'll be cool.
And maybe he can do a little piece on cost segregation studies too, because they're crazy awesome for if you're a real estate professional for eliminating or reducing taxes. So if you're out there, you're listening, and you're a real estate professional, and you are not buying properties and cost segregating them, you are silly. We'll leave it at that.
That was a very nice way to say it. All right.
Calmed down a little bit since the beginning of the episode.
I know. Cool. So, thanks for listening. Like we said, make sure you go subscribe on getrealsuccess.com. Getrealestatesuccess.com. And make sure you subscribe and leave us any feedback and let us know future topics. Thanks for listening.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.